So in today's class, we're going to be discussing group audits. We have our first class was Introduction to Audit and Assurance. Our first class was Internal Audit and Outsourcing, after which we did Introduction to Audit and Assurance. And we went on to do rules of professional conduct. And last week, we also did professional responsibility and liability. You guys can hear me very clearly, right? Just to confirm. Can you hear me?
We can hear you.
Okay, because I got a feedback that the sound from last week was not as great, and I was surprised because you could hear me in class. Okay, so moving on. So in today's class, what we want to do is group audits. We're going to be discussing how to audit a group in the spirit of your CR and your FR, right? You're talking about who a group company is and all of that. We're going to be talking about how to audit a group company, okay? Just give me a minute. You see my screen now. Okay. Okay, so group audits is page 83. So what's a group? What is a group? Fine, in financial terms, what is a group? Hello, I'm asking a question. What is a group?
Well, in the financial terms, group is, should I put in the company, is a company, one or two companies that operate together as one.
Exactly. So is it one or two corporate organizations that operate together as one, or a basically like a company that has subsidiaries that it is directly responsible for, or
They are
subsidiaries?
responsible and controlled.
Exactly. So before a group can enter into a conversation, we want to see elements of control in that group. Can you guys see my screen?
Yes, we can see it now.
Okay. Okay. So so group audits. Now we said that a group audit is the audit of the group financial statements. For this topic, you need to be aware of the requirements of the following standards: IFRS 3, which is business combination; IFRS 10, which is the consolidated financial statements; IFRS 11, which is joint arrangement; and IFRS 12, which is the disclosure of interest in other entities. So as ISA 27 and ISA 28. So these ones are like CR. So you can get into your group, your exam hall, and be seeing questions on group audits that are closely related to CR. They're asking you that, okay, how do you treat investments in associates? Yes, it can happen, okay? But they're just trying to say that it is closely related to what you have already in your CR. So we said group audit is the audit of the group financial statements, and we need to be aware of the accounting standards that relates to group. Business combination is talking about what exactly makes up a group. Consolidation, the concept of preparing joint financial statements. Joint arrangement, these ones are like other arrangement that may not be group but are closely related to a group. Disclosure of interest in other entities. How, if you have a subsidiary or you have an investment in associate or you are a subsidiary of a group, it's important that it is expressly stated, in your reports. And we also have And we also have ISA 28, investments in associates. This is other form of arrangements that you can have within a group that may not necessarily be subsidiary and parent company. Okay, so we're just going to move on into group audit. So basically what we're trying to say here is that how do you audit a group? You know, UBA group, apart from the UBA bank, there are other components of UBA. How do you audit a group entity? We'll first start with saying that the basic work of group companies, of the group auditor, consists of auditing the financial statements of the individual companies in the group. So when you have a group auditor, that person is responsible for auditing the separate individual components of that group. Now, we said for audit purpose, the parent company and subsidiaries are referred to as components of the group. For audit purpose, the parent company and subsidiaries are referred to as components of the group. Of course, right? If you are being called the group auditor, it just means you are responsible for the parent company as well as the subsidiary. Okay. Now, moving on. This chapter is also concerned with the additional audit consideration that arises in the connection of preparation of the group financial statements. Okay. Now, the first subtopic we'll be treating is the possible problems that can arise under a group audit. The possible problems that can arise under a group audit. Think about it, that you have to audit a whole group, right? What are the possible problems that you will encounter? What are the possible problems that you will encounter when auditing a group? The first one you have is that planning for a group audit is more complex than planning for a single audit. Okay, planning for a group audit is more complex than planning for a single audit. Let's say, for example, Dangote. Imagine you are the one responsible for auditing Dangote as a group. Of course, it will be strenuous. Then we have the second reason is that some companies may have foreign subsidiaries that report in their own currency. And now what you are responsible for is basically putting all those subsidiaries that have different different currency together into a report, and then making sure that it meets the demand of the International Financial Reporting Council, which is the IFRS standards. Okay, so you have a subsidiary in different parts of the world, but now you are responsible for putting all these subsidiaries together. Okay, moving on. The second one is that some companies in the group might have different financial year end. Some companies in the group might have different financial year end. And because of this, even when you are preparing group and the subsidiary has a different financial year end, you have to be thinking about how to prorate and all of that. So it's the same constraints that will happen, right, when you are having to audit a group that is maybe even on a larger scale. Different people may have different financial year end, and it's your responsibility to basically put those companies together, right, and prepare a consolidated financial statement. Same thing that you do in your CR. Then we have that some companies may be audited by an audit firm that is not the auditor of the parent company. So let's say, for example, Dangote Refinery was being audited by Deloitte, but Dangote Cement was being audited by EY. You understand? So companies may have had different individual auditors. So companies may have been audited by different financial, different audit firms, and because of that, it may be harder trying to align on, okay, this is how we will work, this is how we will work, and all of that. So if you're just coming to class, good evening. We are discussing group audits today. Okay, so we really just started. We just started with the possible problems of auditing, possible problems with group audits. Okay, so we talked about the fact that it requires a more complex time. Some companies that have foreign subsidiaries, and those subsidiaries have their own currency. Some companies in the group have a different accounting year end. Some companies may be audited by an audit firm that is not the auditor of the parent company. Okay, so these are the problems that can arise from a group audit. We also have the fact that some of these subsidiary companies may be using a different financial reporting standard apart from the one that the parent company is using. Let's say one of their subsidiaries in the US, and in the US they use the US GAAPs. So you can see that that can be a problem in itself. Now, let's move on to terminologies in group audits. Terminologies that you come across when we're talking about group audits. The first one is group engagement team. Who is the group engagement team? It is the audit team that is responsible for the audit of the group financial statements, and will also be the audit team responsible for the audit of the parent companies. So the group team will be responsible for the following. They will establish the overall group strategy. They're also the ones that will communicate with component auditor. They will perform work on the consolidation process. They will evaluate the conclusions that are drawn from the audit evidence. And they will also be the ones to form an opinion on the general group financial statement. So think about the work that a normal auditor would do for a client. That is the extent of work that the group auditor will do for his group. Okay, he will establish the overall group strategy. He will communicate with the component auditor. He will perform the consolidation work. He would now evaluate the conclusion, and any opinion that he gives will come from him being the group auditor. He will not say, oh, this information that I got is because of what this person typed in this report. No, he's supposed to give his findings independently. Moving on, who is now the component auditor? The component auditor is an auditor who, at the request of the group auditor, performs work on the financial information of a component. So think about it. Like I said, Dangote Refinery was being audited by Deloitte, and Dangote Cement was audited by EY, right? If they decide that Deloitte should be the group auditor, EY will be a component auditor to Deloitte, right? In that context. Next one we have is definition of a component. What is a component? A component is an entity or business activity for which a group or component manages and prepares financial statements. So a component is simply a subsidiary. A component is simply what? A subsidiary. That's a component. Now, who is the group engagement partner? The group engagement partner is the partner of the audit firm that is auditing the group. The group engagement partner is the partner of the audit firm that is auditing the whole group. What is he responsible for? He's responsible for the direction, supervision, and performance of the group audit. He's also the one that's responsible for issuing the group audit report. You know, it is not everybody that goes on an engagement that basically signs the audit report, but this person will be responsible for what? The audit report in itself. Now we said the group auditor is okay. The group auditor is solely responsible for the audit report of the group financial statement. The group auditor does not refer to any component auditor unless such a reference is required by law. And when we start to do past questions, we'll see one particular past question where they ask them that, what part of your group audit cannot be delegated? And this is the answer: the responsibility of preparing an audit report, right? You cannot say, oh, what I wrote in this audit report is not from me, it's from this group auditor. It's from this component auditor. That's where I got this information from. No, right? You are solely responsible for the content of that audit report. And you cannot reference the work of a component auditor unless it has been stated by law that provision has been made for that. Now, there's something I actually want us to, before we even get to this place, there's something that I like for students to know. Just give me a minute. Okay, let's continue. I will do a screenshot now and send it to our group. Now, the next thing they start to talk about here is materiality. Is materiality. Is material music scattered. Okay, is materiality. Now we said that the group auditor will need to set the group materiality for the group financial statements as a whole. The group auditor will need to set the group materiality for the group financial statements as a whole. Okay. Okay. So, in setting this, the component auditor would now use what the group auditor has set in place as a materiality concept to know what the next steps for their audit should be. To know what the next steps for their audit should be. I want to send the actual full AAA material because I want us to look at something. I think I already shared it at the beginning of the class, but let me share it again. The pack. Okay. So just give me a minute. Okay. So I want to show something. Okay. Okay. I wanted to show us is what makes up a significant component and what does not make up a significant component. Let's continue because I can't seem to find it now. But one thing we need to know is that in every group, there are some components that may be significant and there are some components that may not be significant, okay? A component that is not significant is a component that does not accrue in general to a high financial control in the overall group, okay? So that is a non-significant component. While a significant component is a component that is significant or that may be significant for two reasons. The first reason is because of its financial significance to the overall group. Let's say, for example, there's no how that you do that Dangote cement will not be significant to the whole Dangote in itself, okay? But let's say Dangote flour now, it may not be as significant to the group, you understand, anymore. Now, we now have the second reason why a component will be significant as significance because of the risks of material misstatement, the ROM that is attached to that particular component. So it's just one just to break it down. It was not even expressly stated in the pack. I was trying to look for it in the pack. But when it comes to a component can either be significant or what? Or non-significant. If it is non-significant, it just means that it does not hold a lot of financial contribution to the overall group in itself. And if it is significant, it can be for two reasons. Either it is significant because of the amount of financial significance to the overall group, or because of the risks that is attached to that particular component. Okay, so to move on, we said that component materiality will usually be lower than group materiality. When you start to get into it, you see that there is one part of your AAA where they talk about materiality and they talk about different threshold. And they'll tell you that if an asset contributes to 1 or 2% of total value of your asset, then it is material enough. Okay, and I know that we have professionals here too that know about all these figures for materiality. So when you hear materiality, it does not mean that it is a large fraction. You think that materiality means 10%. No, in relative to the amount of money or the amount of financial resource that is being controlled by companies, materiality is usually small. 1%, 2% can be material, dependent on what the amount that we're talking about is. Okay, so just to move on, we said that the principles and guidelines for controlling a group audit is similar to the principles and guidelines for controlling an individual audit. Auditing a group is almost the same thing as auditing an individual audit. However, additional considerations arise. These considerations will require the group auditor to do the following. He has to familiarize himself with his client's procedures. These ones are audit procedures for auditing a group. Okay, number one, he has to familiarize himself with the client's procedures and prepare for preparing the group financial statements. He has to familiarize himself because now he's not just knowing about one company, he's knowing about multiple companies. Second thing we said, however, additional considerations arise. Okay, so we said familiarize yourself with the client's procedure. Number two, ascertain the client's timetable for preparing the financial statement. You want to understand how they came about their FS, right? Then we have establish an audit strategy and audit plan for the entire group. Establish an audit strategy and audit plan for how you intend to audit the entire group. Now, we said this audit strategy and audit plan should contain staffing requirements, a timetable for the company's financial statements, and an action plan of possible areas that you will encounter. They're also supposed to have arrangements for the communication with the component auditor. So all these things are points. You know why? This is 1. This is 2. This is 2. Point 3. Staffing requirements, a timetable for the audit. 5. Action plans. 6. And then arrangements for communication with your component auditor. And you know that if it is somebody that you're already used to working with, that is a different conversation entirely. But auditing a group company and knowing that you have to work with different component auditors that you are not used to working with just means more work on your part. Okay, now we moved on to say that it is vital that there is clear two-way communication between the group auditor and the component auditor. It is very important that there's a two-way communication between the who? the group auditor, and the component auditor. The group auditor's requirements are usually to communicate in a letter of instruction. So we know that the group auditor communicates with what kind of letter? Letter of instruction. While the component auditor usually replies with what? A report, a form of memorandum or report of work performed. So the group auditor will send the component auditor a letter of instruction that this is what I need from you. We're going to read the content of the both letters now. The group auditor will send a letter to the component auditor and say, okay, this is the thing that I need from you. And the component auditor will respond with, okay, these are the things that I have done following what you demanded of me. Okay, so we have letter of instruction and memorandum or report of work performed. We said in cooperative with the group auditor, the component auditor will provide the group engagement team with access to relevant documentation provided that it is not prohibited by law. They're just trying to say that in the spirit of doing your group audit, you have the right to request information as you may deem fit from your component auditor, as far as it is not prohibited in their country. So let's look at the content of the group auditor's letter of instruction. The components of the group auditor's letter of instruction. So I know I've not engaged us this evening. I'm just looking at it that you guys may have had a long day. I had a long day as well. But hi, Ibukun. Let me just outline it. I'm not sure why students don't have numbers. So kindly read out the content of the letter of instruction for us. Can you hear me?
Yes, I can. Good evening.
Good evening.
Okay, so the group auditor's letter of instruction to the component auditor should set out, number one, the work required, number two, the use to be made of that work, and the form and content of the component auditor's communication with the group engagement team. Number four, a request for cooperation. Number five, ethical requirements. Number six, component materiality. Seven, identified significant risks. Eight, a list of known related parties.
Okay, thank you very much. So just like we said, the group auditors is supposed to send a letter of instruction to the component auditor, telling him that this is the work I require from you. These are the level of checks I need you to do. Second thing, this is the reason why I need this work. The third one is the form and content of their communication. In this audit, we'll be communicating through this and this. We'll have 4 strategic meetings at this time. They'll also send a letter of cooperation, a request for cooperation, saying that I'm going to need you to work with me at this time to help us achieve our goal together. The fifth one we have is ethical requirements, that, okay, I'm working with the International Financial Reporting Standards, and since we are a group component, this is what we're going to subjecting ourselves to as an overall group, okay? Then component materiality. You can say, okay, any amount that is up to 1% or 1.5% of your profits before tax is material. They can, give out that percentage, and then that is what the component auditor will begin to work with. Then we also have a list of identified significant risks. This is what I think are the things that can affect people, and it's also going to ask the component auditor for a list of known related parties, right? Now, the component auditor is not supposed to submit to him a report of work performed. The component auditor is supposed to submit to him a report of work performed. And what should this report of work performed include? So let me call another person. Obed, can you hear me? Good evening.
Yes, I can hear you.
Okay. So kindly read for us. Trying to label it well.
Okay.
Okay, you can continue so that I don't distract you.
Okay. So the component the component auditor's report of work performed should include: one, a statement of compliance with ethical and group auditor requirements. Any any instances of non-compliance with laws and or regulations which could lead to a material misstatement of the group financial statements. A list of uncorrected misstatements of the financial information of the component. Indicators of possible management bias. Any identified material weakness, any identified material weaknesses in internal control, any other significant matters the component auditor expects to communicate to those charged with governance of the component, any other matters that may be relevant to the group audit, and the component auditor's overall findings, conclusions, and opinions.
Okay. Thank you. Okay, so the component auditor, like I said, is responding with all the questions that have been asked. So if you look at it, it's like a call and response. The work required, he asked him for ethical requirements. So that is the component auditor replying with a statement of compliance that, okay, we are going to comply with the ethical and group auditors requirements. Also, any instance of non-compliance that could lead to misrepresentation of the group financial statements, and that is what the auditor has already asked in the above, where he asked for the identified significant risks. Okay, then a list of uncorrected misstatements in the financial statements of the components, that is also identified significant risks. Then we have indicators of possible management bias. This one usually stems from related parties or issues in-house of that component. Since is the component auditor that audited that component, is in the best way to actually know, what exactly to do, when such matters arise, or how exactly the group auditor, so how exactly to loop the group auditor into the conversation that is going on. Okay. Then we have any identified material weaknesses in internal control. Those ones too, they are also under identified significant risk. Then we have any other matter that may be relevant to the group audit. He must bring it to the attention of the group auditor. And then the component auditors overall findings, conclusions, and opinions. So it's just important to note that the group auditor communicates with the component auditor using what we call a letter of instruction, while the component auditor responds to the group auditor using what we call a memorandum or report of work performed. Okay. Now, we've said that where significant risks of material misstatement of the group financial statement has been identified at the component level, the group auditor should it should evaluate the further procedures. So this one are just audit procedures. When there's a risk of misstatement that is coming from the components level, what should the group auditor do in this case? He's supposed to check his audit procedures that are in place to avoid such risks. And what are the kind of things that he can do? Because he's not the component auditor, right? But like I said, you cannot delegate your function as a component auditor. You cannot delegate your function as a component auditor. Say, okay, this thing was not my responsibility, or the reason why there's an error in this thing is because that is what my component auditor gave me. You have to take responsibility for that audit. So what's supposed to do when they realize that there's a material misstatement? The first one we have is that he's supposed to schedule a meeting with the component auditor to obtain an understanding. You see, this audit procedure called obtain an understanding is very important. And I always say it because audit is usually done in accrual, right? You are auditing historical data. the FY has already concluded at the time where your audit is going on. So you need to ask questions so that you can appropriately know the right answers. So we said it's important to have a meeting with the component auditor to obtain an understanding of the components. Then you move on to reviewing the component auditor's overall audit plan. You perform risk assessment procedures at the component, and then you will now design further audit procedure that may be relevant to like cushion the effect of that particular risk. Then you will now review other relevant part of the component auditor's documentation. It just means that the risk factors that you are considering for that particular audit or that particular component has increased. Okay, so that is it though. That is the major thing that is in group audit. After exam questions in group audit is typically problems associated with group audit. They can ask you terminologies. What is the meaning of component auditor? What is the meaning of group engagement partner? Right? What is the meaning of group engagement team? And then we also have audit procedures when you are planning and controlling for a group audit. They can also ask you that what part of your group audit can you not delegate? And that's why I said that you cannot delegate the responsibility of preparing the audit report, or you cannot delegate the responsibility that comes with preparing the audit report to the component auditor, saying that you relied on his work. That will not fly. Then another exam question is how communication is being done between the group auditor and the component auditor. And that's why we said that the group auditor uses a letter of instruction, while the component auditor uses a report of work performed, memorandum or report of work performed. Exam question 2, listing out the content of the letter of instruction, the work required, the use of the work that is required, the contents of the form and content of the auditor's communication, a request for cooperation, ethical requirements, component materiality, and the identified risks. Similarly, the component auditor responds based off of the questions that have been asked in the letter of instruction. Yeah, and then we now move on to when there is still a significant risk of material misstatement, what should the group auditor do? And that's why we say that he has to obtain understanding from the component auditor and the component auditor's management to say, okay, what's going on? He has to review their overall audit strategy. He has to perform risk assessment procedures and decide if he wants to add further audit procedures before he now reviews the component auditor's documentation to say, okay, what are the things that you have put in place before, and how can we like make sure that these things are actively solving a problem for us. Okay, so moving on, the second part of the chapter, there are 2 parts of the chapters. The second part of the chapter is joint audit. Now, for group audit, like I said, somebody is auditing Dangote as a whole, right? And there's refinery, there's cement, there's flour, and all of that. But for joint audit, it is when more than one audit firm is being engaged to carry out a procedure. More than one audit firm is being engaged to carry out a procedure. That is joint audit. More than one audit firm is being engaged to carry out a particular procedure. Okay? So you can read for us. Let me call somebody to read for us. You just read joint audit. Hi, Anthony. Good evening. Just read the introductory part of joint audit for us. Can you hear me? Hello, is Anthony with us? Hi, Ayodeji. Okay, yeah.
Hi,
Good evening.
good evening.
Yeah. So please just read joint audit for us, just the introductory parts.
Okay. A joint audit involves 2 or more audit firms being appointed to audit the financial statements of an entity. Joint audits are mostly found in group audits. In particular, when a group acquires a new subsidiary, the joint audit provides a joint opinion on the financial statements of the subsidiary.
Okay, thank you. So, like I was saying, for joint audits, it's just audits involving two audit firms that are appointed to audit the financial statements of an entity. And like we said, joint audits are mostly found in group audits. Joint audits are mostly found in what? In group audits. And we said in particular, when a group acquires a new subsidiary, they would be like, okay, let this new subsidiary auditor still work with the parent company auditor for now, so that they can, loop the parent auditor in to what is going on. Okay. And then strategically, they will now easing off the arrangement, maybe moving forward, maybe after the first 2 years, the group auditor will have already known about how to go about this auditing the subsidiary, will have had enough information. And that's how they will now, sometimes start auditing it alone, right? But for joint audit, it's basically appointing two audit firms to be your auditor. Okay, it's basically appointing two audit firms to be your auditor. Okay, now what are the advantages of joint audits? From everything we have heard, what are the advantages of joint audits? What do you think will be the advantage? This case scenario that I gave us, that okay, you have a new subsidiary, and then you're thinking that okay, pending when this our parent auditor know about this subsidiary well, we want this component auditor to work with the group auditor for the time being. What do you think will be the advantages of joint audits? Hello, have we had a long day? What's going on? Hello.
Please, can you come? Can you come again? I didn't hear.
I said that. Is my line breaking? Can you hear me?
It was breaking at some point. We can hear you.
Okay. So I said that, what do you think will be the advantages of a joint audit for the case scenario that I just said now, that okay, you acquired a new subsidiary, and then they are saying that okay, before the parent auditors, right, know fully about that subsidiary, let the subsidiary auditor work with the parent auditor on a joint audit basis. You understand? Before, after some time, maybe after like 2 years, that the parent company already knows a lot about the components company, you understand? They can answer that okay, we'll be auditing alone. So with that kind of arrangement, what will be the advantages of joint audits? I'm saying before we start reading the answers that are here, what are the advantages of a joint audit?
I think.
Can you guys hear me?
Hello? Can you
Yes,
hear
I
me?
hear you.
Yes.
I think one of the advantages in the scenario that you just gave now would be that there will be like a more since they don't have knowledge of the business yet that has been acquired, and the people that have previous knowledge of it are still the ones auditing it, they'll have the chance to work side by side and also learn before they will be able to hand over.
Okay. They are able to work side by side. They're able to like have more information on the components of it all. Okay? Yeah. So yeah, that's a good one, Sha. And me, when I look at it, I always think that most of the time it gives like smaller audit firm an advantage. You understand? That they will not even have been able to audit a caliber of clients. Okay, and it even happens in our today's world. Sometimes the big fours they can engage a big four and another small audit firm to carry out an audit work. You understand? So let's read what we have there directly. It said that advantages of joint audit. Number one, the size of the client company may be large, that it requires the service of more than one auditor. So if it requires more than one auditor, and there's a provision for auditor, don't we think we should be taking it? The second one is that after the acquisition of a large subsidiary, using joint auditors might help in the transition process while the group auditor becomes familiar with the new subsidiary. And that's what I was explaining, okay? The third one is that joint audit may provide a higher level of technical expertise. You know how when it's two people that are doing something, you don't want to show that you don't know your work, right? And just putting in all the effort, you are putting in all the work, just be able to do that particular thing well. So that is what will typically happen. Everybody will want to bring their best game forward because they know that they are being watched by another person. And then the fourth one we have is that it gives opportunity to medium-sized audit firms to join forces and tender for jobs the big four normally tender for, okay? Because I know that, okay, it's more than one person that they will choose, and because of the price, maybe price point of the big four, they also want to consider getting a small audit firm to like work on this audit too. Those are the advantages of joint audits. Basically, the advantage of the clients, right? And also giving smaller firms an opportunity to actually work on engagement that they would ordinarily not have worked on, okay? Now we have disadvantages of joint audit. What are the disadvantages of joint audit? The first one is that it's likely to cost the clients more because they are using two accounting firms. No matter how much you say, oh, they're giving them an edge, blah, 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 it will most likely cost the clients more because in real sense, they're actually spending more money, okay, on the audit. The second one we have is that there is a possible inconsistency between the two auditors. This one will say, no, this is not how you do this. This is not how you do your circularization. This is not how you understand. If anybody here works with the big four, like you work in an audit firm, you know that different companies really have how they carry out their own operations. Next up, we have the possible difficulty in agreeing on division of work. This person does not want to feel like they are being used on the work. And this other person is saying that, oh, you should just be grateful you are here. Have you? We're the ones that even literally just gave you a job. And this person is saying that, no, we came here because we are qualified. So trying to align on their both strategies might be difficult. Then we also have the two firms might find it difficult to work well together, and each firm may try to become the leading firm in the joint audit. So for group audits, you know that this is my group auditor, and I'm supposed to work with this guy to make sure that I achieve my purpose. But with joint audit, what is happening is that there's no in term a orga, right? And somebody wants to just take somebody wants to take over like a larger portion of control, and that in itself can lead to them having issues. Okay. Yes, they said that if there is a claim against auditors for negligent conduct of an audit, there may be some difficulties at identifying which joint auditor is liable. Okay, this is another point, the fifth one, that if there is negligence, who will come and take responsibility that, oh, I'm the one that did the wrong thing. So it may be hard trying to, get who was negligent if a claim of negligence arises. Now, we are saying here that the key to a successful joint audit is good communication between the firm, including joint planning meetings and regular discussions between firms at all key stages of the audit process. It's very important that there is good communication between firms at different points in the audit. Do we have any questions to this point? It's actually a very straightforward topic. And it's not even a topic that when it is being asked, there's mago. It is very direct and straight to the point. Okay, so we're going to move on with documentation. Now, in addition to meeting the requirements of ISA 230 audit documentation, the group auditor must document the following matters. Number one, we have analysis of components. The second one is the type of work that is required by the components. Number three, very important, the extent of the group auditor's work in the involvement, the extent of the group auditor's involvement in the work of the component auditor. You want to have it down. It does not mean that you can blame the component auditor for something that went wrong, but you just want to know that this is the extent of work, this is the extent of review that I'm doing of the component auditor's work. Then we have written communication between the group auditor and the component auditor about the group auditor's requirements, saying that, like, that's why the letter of instruction and report of work performed is very essential. That's what gives you an overview of the conversation that has been held between the both of them. Okay. Then we have communicating with the group management. The group auditor should make sure that the group management is aware on a timely basis when they are the following: when there are material weaknesses in the group, when there are material weaknesses that he has identified in the components, when there are material differences that he has identified in the components, when there are material weaknesses that he has identified to the group that the component auditor have identified at some point and brought to the attention of the group auditor. You know, those are the kind of things that he asks for in the letter of instruction. So if the group auditor notices, or when the group auditor notices these things, it's very important for him to also relay to management that these are the findings that we have, such that if there are any suspicions of fraud, they're supposed to communicate it to management. It's just like typically what will happen even if it was not a group audit. Okay, it's typically what will happen even if it was not a group audit. The last part of the chapter is now communicating with those strategic governance of the group. ISA 600 now requires the group auditor to communicate with those strategic governance. And what's supposed to communicate? Number one is the type of work performed on the financial component. Number two is the group auditor's planned involvement in the work of the company auditor. Any other concern over the quality of the company auditor's work, because you know he is going to go and meet the board now, right? So he's also saying that, okay, this is what I think about this company auditor, right? And all of that. So he's supposed to basically give his feedback. Then any fraud that he has seen that involves the group management, any fraud that he has seen that involves the group management, is also supposed to expressly communicate it, you know, with those that are charged with governance. So like I said, it's really a direct chapter, but we also have like another 1 hour to just go over our past questions. So we'll be going over all the questions that have been asked on our group audit. Before we start to do the questions, I want to ask that do we have any questions to this point?
I think there is no question.
Okay, very good, because me, I have plenty questions, and as I'm doing this past question, let us not fight though. Let us not fight. Okay. I'm coming. Okay, so your group audit has come out. From here, we can see that our group audit has been tested 6 times. 6 times. Let me just put them on the chart. The dates where they were tested. November 2014, question 4. So let's just go to our Pathfinder. Okay, question 4. So in this diet, they gave them different matters and they said that the Cinnamon Group is an international business made up of 10 subsidiaries. You are the manager in charge undertaking the group audit, but but they are separate local auditors for the same subsidiary in the United States. You are aware of the following information. Hybrid is a loss-making subsidiary with current year loss totaling 27 million. There's significant control problems, high level of bad debt, and 25% staff turnover. The local auditors have already said their intention to give a qualified opinion for the year just because of the material issues found. So they now told you that you should consider how you want to plan and control the group audit. The planning and controlling of the group audit is what we have here, where you familiarize himself with the client's procedures, ascertain the client timetable, establish an audit strategy, which includes the staffing requirement, timetable, action plan for possible areas, and arrangement of communication. So that is the A part of this question. B is consider the impact of these issues on the group audit. Now, the first one is, this was the only time that it actually come up, is what we call, where we use comfort letter. What's a comfort letter? A comfort letter is a letter that is being sent, okay? Okay, let me continue. The ICAN is operating a different financial canin, or what's the correct pronunciation of this? Kayan, right? What's the actual pronunciation of this word? What's the actual pronunciation of this word?
We will take your pronunciation for it.
Huh?
We will take your pronunciation for it.
Is the pronunciation in English language or in Nigerian language?
In English language.
Okay, I don't know. But in language, I'll call it Kayene. Don't mind me.
Cannot be Kayenne now.
I was just joking.
I think it should be Cayenne. Cayenne. Okay. Cayenne is operating a different financial year end to that of the group as a whole. So the second one, this one has a different financial year in October instead of December. Shortly after the year end, in January 2014, the Cinnamon Group announced the sale of Abeto for 250 million, and the disposal is currently going on. So how do you treat these matters? The first one is that Hybrid is a loss-making entity, and they said that they want to qualify their reports because of the material issues. And yes, they are correct for saying they want to qualify it, okay? Except the parent companies issued what we call a letter of comfort. What's a letter of comfort? This is the only time it came out, and it was not even in the material. So letter of comfort is a letter that is being sent by the parent company stating that in the event of a loss materializing in a subsidiary, they will provide sufficient cover, okay? That is a letter of comfort, right? That is being sent from the subsidiary company to the what? To the parent. So that's sent from the parent company to the subsidiary company. The second one is that this cane has a different year end. It just means you have to prorate. Abi, you have to prorate to be able to factor it into the group financial statement. And the third one is that they said that after January 2014, they announced the sale of one of their subsidiaries. So that means that subsidiary will not be part of the subsidiary that you consolidate. So that was so that most of your group audit questions will be like normal CRO questions. You understand? So if you know CRO normally, you will not have an issue. Then they said, explain the relationship between your firm and the auditor of the subsidiary, making reference to the extent which you may rely on the component auditor's work and to the considerations involved where the component auditor are conducted. So basically, it's what I said about the fact that the group auditor will reach out to the component auditor using a letter of instruction. The component auditor will respond using a report of work performed. But the group auditor cannot come and say that the result of his work was gotten from an information that he got from the component auditor. That cannot work. So let's also check May 2017 question 6. They said you are the senior auditor in the ABC firm of chartered accountants, a Pan-African audit firm. You just resumed from your examination leave and have received the following email from Ms. Chidi, an audit manager in your firm. Dear Audu, welcome back from your leave and best of luck in your examination. We have just been appointed the financial statements auditor for Gbogbo Nishe PLC, a conglomerate having a head office in Lagos. Our preliminary discussion with the group financial officer indicates that the company has 5 subsidiaries and 2 associates. One of the subsidiaries is incorporated and operates in Ghana, while one of the associates is incorporated and operates in Gambia. The other members of the group are incorporated and operate in Nigeria. The group operations cover automobile, agriculture, and manufacturing. We'll be meeting with the group. We will be meeting with the audit committee in 3 weeks to present our audit strategy and plan, right, for the assignments. Please draft the following. A, challenges encountered. Straight and direct. Straight and direct. Abi, we have different currency, different accounting practices, different year end, and different auditors apart from the component auditors. Okay? Straight and direct our answer, 5 marks. General procedures to be performed on a significant component and a non-significant component. So, like I said, there's some questions on this group audit that I don't know where they got it from. So for a significant component, the component auditor would work with the component's materiality that has been given to him by the group auditor. Then for a non-significant component, for a non-significant component, he would also, for your significant component, there are 2. When it is significant because of the risk of material misstatement and when it's significant because of financial significance. If it's significant because of the risk of material misstatement, he would do it based off of the group auditor's demand, right? But if it's based on the financial significance, it is based on the group materiality. Then for non-significant components, it's also based on the group materiality. Just 3 marks. You can just read this so that you can update your knowledge. Then they said, what are the items to be included in your group audit instructions? All this, the letter of instruction, that's what will be included. You ask for a cooperation, you tell him the work that you want him to do, ethical requirement, all of that. Then they said procedure to be performed in relation to consolidating a group. This one is a CR question. What do you do when you are consolidating the group financial statement? That's what you will do in this case. Okay. Next up, we have May 2019 question. Okay, is it May? November 2018 question 6. November 2018 question 6. Okay, they said they also here to the reference that use of component auditors work. Identify 4 factors that needs to be considered when you are using the component auditors work. And this one is like normal reliance on an external auditor's work. You have to check the level of independence, the level of technical competence, what reporting standard is using to work, and his level of cooperation, you understand, with the requirements of the group auditor. Then it said, discuss 3 principles to be applied when determining the work to be performed on each component. So the principle is if it's a significant component or if it is not a significant component. How? If it's a significant component because of financial significance, you do components materiality. If it is not because of its financial significance, you check based on the level of work that's been required of the group auditor. And if it is not significant, you also do component materiality. Then they said, maybe this was in the pack before now because it's no more there. Yeah, then they said list 4 contents of the group auditor's instruction. The same point again, right? That are already here. The work required, the use of the work, request for cooperation, ethical requirements, component materiality. Okay. And then we also have November 2019 question 2. They said, explain 3 conditions under which a parent company need not present consolidated financial statements in line with IFRS 10. This one now, they just came and they asked you, see how. They said, explain the consideration that must be met for an investor to consider an investee as stated in IFRS 10, while for when that is examining IFRS 10. Then they said, if the group engagement team plans to request for a component auditor to perform the work of financial statement, the group engagement team is required to obtain an understanding of the component auditor. Explain 4 matters that the auditor needs to consider in obtaining an understanding from the component auditor. What are the matters that he's considering? It's the same matter that he has always been considering. Coming. Okay. So the same matter that he has always been considering. He has to familiarize himself, ascertain client timetable, establish the strategy, staffing requirement, timetable, action plan, and arrange for communication. Now, they said the group engagement team shall request for the component auditor to communicate relevant matters to the group engagement conclusion within the group audit. Explain 5 matters that are covered in the communication. To be honest, the matters are limitless. Everything that is in the FS, they can communicate on management bias, they can communicate on fraud and error, they can communicate on like the group auditor is asking significant risks. Abi, they can communicate on method of carrying out an audit or a certain procedure. If the group auditor wants the audit to be carried out in a certain way, he will request. So this diet, just ask them whatever they chose is. And I think the last time is 2 more times actually. We have November 2023 question 2. But I'm sure that we don't have that here. So you can see that it's actually an easy, breezy topic. There's some questions I was looking for. One diet where they asked them the direct disadvantages of joint audits. I'm coming. Okay. Okay, see this one. November 2022 question 1. They said you should evaluate the justification or otherwise of having joint auditors. Evaluate the considerations or otherwise of having joint auditors. What are they asking you here? When they say you should evaluate the consideration or otherwise of having joint auditor, what are they asking you?
Advantage and disadvantage.
Thank you. 8 marks question. 8 marks question. All the remaining ones are not, they are not like group accounts, but 1A is there. So, like I said, it is actually a very direct chapter. So that is even short, less than 4 pages. Where you have complications, maybe they want to ask it in terms of CR, like you see the case where they were asking them IFRS 10 and all of that. But ordinarily, there's not so much in it. You know, it's just a straightforward chapter. All they together ask is problems, technologies, content of letter of instruction. There's even one day where they ask them content of letter of instruction. I don't know why I'm not. There was one day where they asked them content for the letter of instruction and content for the auditor's report of the company auditor's report of work performed. We're not seeing it here. So I don't know if anybody has any other question. Do we have any question like based off of this chapter? Because do you have any other question? Or should I ask my question? Somebody in the class should differentiate between group audit and joint audit for us. Differentiate between group audit and joint audit for us. Hello?
Group audit.
Mm-hmm.
Okay, group audit is an audit of the parent company and its subsidiaries. That's the component company and the subsidiary and the parent company. Well, joint audit is the 1 or 2 audits that come together to audit a financial statement of a firm or of a group.
Okay. Okay. I said like who wants to try? Who else? Who else wants to try? I have 8 people in this class now. Hello, can you guys hear me? So basically, a group audit is you're auditing a whole group. There is a group engagement auditor, right? And then the remaining auditors on the engagement are referred to as component auditors. While for a joint audit, there are 2 auditors that are working on an engagement. The engagements may now be for a group. Do you understand? But there are just 2 or more auditors that are working on a certain engagement. That's just different between the both of them. Okay. So do we have any questions to this point? Any question, anybody? Mr. Soji, I didn't even hear your voice today. Are you with us like this?
Yes, I am.
Okay. Okay. No problem. So my people, that will be all for now. It's a very direct and straight to the point topic. So the recording will be made available and let me know if you have any other question. Okay. Can you guys hear me? Are we good?
Yes, we are good. But sorry, before you go, did you mention anything? Because I don't know, maybe I joined the class late. Did you mention anything that has to do with procedures relating to accreditation? Audit procedures? related to consolidation. Did you mention anything like that?
Okay. Yes, and that's supposed to be in the actual material. I'm coming.
Because I've seen a question like that before.
Yes, yes. I'm sending a screenshot to the group. So thank you for that. Let's take it. Okay. I'm sending it to your group now.
Okay.
Okay. So when we're talking about procedures relating to consolidation, it's just from the end of the group auditor, we're saying that what is the role of the group auditor when it comes to consolidation? And we said that he's supposed to, on that, number one, check that there's been full accuracy of information in the individual financial statements of the components before he even gets to his part. Then the second is that he's supposed to make sure that consolidation adjustment, the same way when you are doing CR, you have consolidation adjustment. He also has to make sure that consolidation adjustments have been made, right, to that whole group addition that is supposed to have. So what are the main audit procedures? Number one, checking for clerical accuracy. This one is just to check that all the information that have been transferred are like correct. All the information that has been transferred are like accurate when it comes to arithmetical accuracy, plus and minus, okay? The second one we have is status of investments. Now, he has to confirm the parent company has correctly classified an investment. That's where we got that kind of question where they're saying that as of January 2014, they already sold a subsidiary. It will be wrong for them to be consolidating a subsidiary that they already sold, okay? So that is that about the consolidation process. Number one, you check for arithmetical accuracy. Then you also check for status of investment. Next one, he has to check if there are changes that have occurred in the group. He has to check if there are changes that have occurred in the group. For acquisition, he has to confirm that a fair value has been used. If they've been acquisition during the year, he has to make sure that purchase consideration are being considered. The normal purchase consideration that you do for your group account, you also look at it. You have to make sure that if it happened during the year and there are contingent considerations, you want to make sure that all those conditions have been met. If there are disposals, that they properly calculated the gain or loss on those disposals, and that the accounting treatments are currently applied on these changes that have occurred in the group. Similarly, you also check for like consolidation adjustments. You know how you have your intergroup trade, all of that, intergroup loans, all of that. The auditor is also responsible for checking for it. Then, if they are loss-making entities, he has to consider whether any goodwill acquisition has suffered an impairment, right? If an entity has started to make a loss, okay? And then he has to write down the value of the investments in the parent company, such that we understand that, okay, this subsidiary is making a loss continuously. Are we saying that their going concern has now been threatened, such that we can inform the group and they will take a formal decision where they will now be considering the use of a comfort letter? Exactly. I was trying to what I was looking for in the material. That I was like, where exactly is this thing at the beginning of the class? Then we said, under related party, you have to ensure that the provisions of IAS 24 is being complied with. And this one is just saying that we have to appropriately disclose in the notes to the account that, okay, these people are related party and we have probably disclosed them in our notes to the account. Then the last one is reporting. And this one is just to make sure that the conclusions that are being reached about the company, right, are reflective of the things that actually occurred in that particular financial year. Now we have that we should note that consolidation adjustments that are made after the financial statements of the consolidation adjustments are made after the financial statements of the individual group have been prepared. Okay, so consolidation adjustment is just for the group to meet up with the group policy. Okay, so thank you very much, Mr. Soji, for calling our attention to that. So yes, we'll take note of it and add it to the material moving forward. So there are about 6 of them, or yes, arithmetical accuracy, status of investments, changes in the group, consolidation adjustments, and when we have the last one as loss-making investments, related parties, and reporting. Okay. So we don't have any other question.
Thank you.
Thank you, everyone. Thank you for your time. Give you guys about 30 minutes. That's been a long day. So let me know if you have any other questions at all. Okay. Thank you. Bye.
Good night.
Good night.
Thank you.